Hey guys, and welcome to Deep Dive Stocks. My name is Justin, and today we're going to be looking at the hedging heat maps. So today's going to be a little atypical for a data dive. We're not going to look at just one stock. In fact, we're going to look at two, and we're pretty much only going to look at these stocks through the lens of the that's the newsletter, the Gamma Hedging Heat Maps. And that's what we see in front of us. And so let's talk about what they are, what they measure, and how we can use them. So let's get started. So the Gamma Hedging Heat Maps measure the amount of net directional gamma in the market for every stock that the data is available for the options to be directionalized on. And the cool thing is what that lets us do is see where exactly hedging has to occur. It lets us see how much hedging has to occur. And it can be pretty powerful, especially when it's not uncommon for a stock's daily volume to be 20, 30, sometimes even 40 or 50%, or in SPY's case, sometimes it's over 100% of the anticipated daily volume can be directly associated with either delta or gamma hedging. So gamma hedging is a pretty dynamic force in the market. It is a lot more fluid than just delta hedging. And so that's why I think it's a pretty important tool and a pretty powerful tool for us to monitor. So let's start with SPY's hedging heat map from last Friday. So that would be May 20th, 2022. And we have it right here. And what we see is there's a few things that we should probably point out. The first to the upper left is the influence distribution. And this just tells us how much of each kind of tier or strength or magnitude of the hedging that we have. So we see that the predominance of our hedging is split between 0 and a very soft purchasing. We have a pretty equal distribution of some moderate selling pressure. And so this just gives us an overall feel for what is happening in the hedging environment when it comes to gamma. The blue on the map represents purchasing support. So if a stock finds itself in the blue zone, that means that gamma hedging is geared towards purchasing of shares, which typically drives the price up. And then the red is the selling pressure. So if a stock finds itself inside of the red zone, that indicates that all of the gamma hedging or the net gamma hedging is geared towards selling of shares. The x-axis right here is the volatility. So we can map out, because we know which options are dealer long, which options are dealer short. We can map out how the hedging changes as the volatility changes. And the same with the price on the y-axis. So we see the price goes up here and the price drops as the y-axis goes below. The crosshairs represent where the stock currently finds itself, so the IV and the price pair that match with the stock's current conditions. The white zone is the gamma neutral zone, and you'll typically find that a stock tries, we'll do some air quotes there, to stay inside of the gamma neutral zone because, well, the whole point of delta and gamma hedging is to be neutral. So we'll see that a stock typically tries to migrate back into the gamma neutral zone when possible. This is the hedging heat map from Friday, May 20th. And what I did was I went ahead and overlaid the next weeks. So this week, the week that just occurred, the price action and volatility over top, just so we can see how the hedging heat map was pretty helpful and indicative for us even a week out. So a pretty common question I get is, well, when does the hedging heat map need to be changed, or when is its kind of like usefulness? And the idea is that the hedging heat map is timeless, right? There's no component of time. There is strictly just the component of the options and which types of options are on the field. So as long as the options don't change too drastically, the hedging heat map is good until things change too drastically. Either the price, the volatility, or the options landscape finds itself pretty altered. One of the ways that I use the hedging heat map is the Friday of the week before. literally just like this. I just monitor each day, and then I look at each local heat map and the local data on the deep dive stock reports to figure out what the most likely changes or what the most likely preceding price action is, with kind of the undertone of the hedging heat map from the Friday before. So we see that on Friday we ended just against the purchasing support, and so on Monday we did rise a little bit. We continued to stay inside of the purchasing support on Tuesday, and on Wednesday we're going to look at the data there because we actually kind of just jutted directly into the gamma neutral zone. And again, that's the idea that a stock typically likes to be inside of the gamma neutral zone. But we're going to see on the local data from the 25th, it was pretty bullish. And so the SPY, so the ETF, got knocked back pretty significantly back into purchasing support. And this is pretty moderate purchasing support. And then we ended the week here on the 26th. Oh no, that should be the 27th, with some pretty significant purchasing support. So the overall theme was that we started the week up against purchasing support, and we ended the week with even nicer purchasing support, and we ended up spot up, volatility down, which is a pretty nice way to end the week. And the hedging heat map here gave us a pretty good heads up for that, especially if we look at the previous SPY hedging heat maps, which were pretty not so good. So now let's look at each individual hedging heat map for each day. So this is the 20th. This is the one that we just saw. We see, one last thing. We see that SPY as a ETF as a whole was in a gamma squeeze. And this is notable because the selling pressure was below the spot and purchasing support was above the spot. We're going to see later in SPY where that is actually inverse of what we want. We always typically want some subtle selling pressure above, but some pretty robust purchasing support below. The idea being that if the index falls or any individual stock, that purchasing support provided by the options will come in, act as a passive bid, and kind of level out the index, giving investors a little bit more confidence to jump back in. So then on Monday, what happened on Monday? We went up 1.87%. We dropped our volatility by quite a healthy chunk. And so this was the local environment that we found ourselves on in Tuesday. And one of the interesting things that is a kind of like a hedging pattern is that we're going to see this purchasing support is going to start rotating around, and it's kind of like going to come clockwise underneath the spot. And whenever that happens, it's actually a pretty good sign. It's a stabilizing sign. And we see that starts to occur here. So we see that the purchasing support moves quickly over to the right. We're locally inside of the gamma neutral zone. And the idea here is that if we drop our spot, so if we go down and our volatility increases, which is usually like the most common pairing when the price goes down, we're going to run into some nice purchasing support. So in comparison to the Friday before, where if the index fell and volatility increased, we would have a much more drastic selling pressure. On Monday, immediately we see that the index was actually stabilizing quite nicely. Because if we fell into this quadrant, this like lower right quadrant where volatility rises and the spot goes down, we're already going to start meeting purchasing support. Now it's not all that significant, right? It's pretty light blue, doesn't even have any numbers, but it's better than selling pressure. Conversely, if the price does go up and volatility drops pretty significantly, it does have a pretty nice corridor here for the gamma neutrality to kind of ward off any selling pressure. But if volatility dropped too much, or if it does drop too much, put ourselves in the mindset of being on Monday night, we would be concerned that this would start causing some selling. Then we go to Wednesday. So Wednesday the 24th, we ended. What did we do on Wednesday? Is this Wednesday? Tuesday the 24th, we did drop a little bit and volatility rose. And where did we find ourselves? So locally, we found ourselves inside of some selling pressure. That's not too good, but we are still if with volatility up, spot down in this lower right quadrant, we see that the purchasing support is still present, which is actually something that didn't occur last week. If we looked at last week's hedging heat map, there was, after the day or two of green, this purchasing support actually regressed back into the upper left quadrant. But we ended the day in some selling pressure, so that would be concerned that on Wednesday that selling pressure may kick off some selling. But again, things are pretty stable because if the spot goes, if the price drops and volatility increases, we're going to start running into some purchasing support. But it looks like in the local environment, things are it'll be hard to like rise too much, right? Like if you rise too much and and add too much liquidity to the index, you're going to start getting some pretty hefty selling pressure. And in fact, we can see that this kind of like quote unquote left tail event in the influence distribution, where the selling pressure can, or by magnitude, is much more significant than the maximum purchasing support present. So still pretty unstable position, but better than how we ended on Friday still. Then finally Wednesday, I was so eager to jump ahead. We went up 0.88%, and we actually, we dropped our volatility by 20.5%, which is pretty wild. No, we increased it, sorry. Which is good, right? Because we said we didn't want the volatility to drop. We actually wanted volatility to increase. So interesting that we did have a spot increase, volatility increase, which was actually almost like exactly, quote unquote, exactly what the index needed in order to like sustain growth. But that's neither here nor there. Forgive my puppies waking up from their nap. So we see again, we're up against some selling pressure, but purchasing support is slightly getting better. And again, we're stable because if spot goes down and volatility goes down or goes up, we're going to have some purchasing support to provide that passive bid on the index. The selling pressure is still pretty worrisome. It's worrisome there. That's not a word. But the take-home point here is, again, slightly cautious that we're up against the selling pressure for any negative returns on the next day. But the overarching theme that the purchasing support is actually getting stronger. It's still located spot down, volatility up. So that gives us some confidence that if the index does fall, there's going to be an ever increasing amount of passive bid coming in to stabilize the index. Then on the 26th, what do we do here? We went up by 2%, very nice. We dropped our volatility by 24%, very nice. And we ended the Thursday with for the first time in a very long time, not in a gamma squeeze, and with a very stable hedging heat map. So like we said before, we want some casual selling pressure above, so maybe 2.3 in magnitude is a little bit much, but we can see that in order to get there, we're going to have to go spot up, volatility down, all the way to like a implied volatility of 15%, which would be pretty remarkable given that we were at 25%. But the caveat or the trade-off is that we now have full purchasing support if spot drops. So there's almost no risk of like a volatility mediated sell-off, because like before, if spot dropped and volatility also dropped, we would start getting this like volatility mediated sell-off. But here, the hedging is almost completely being governed by the spot, at least for the purchasing support. And we do have some nice casual selling pressure located spot up, but overall, it's not too bad. We see that the majority of the selling pressure is about negative 0.15, whereas we have some pretty healthy, kind of like just a nice general distribution of this purchasing support. And like I said before, this is what you want to see ideally in a hedging heat map. It tells us that we're going to get a little bit of selling pressure as the spot increases, but what we really want is for if the index or individual stock falls, we want that nice passive bid to be there. And this is actually the first time that SPY has had like a fully developed stabilizing hedging heat map. So it's kind of nice to see. So with Thursday, we ended Thursday, the 26th, with honestly pretty optimistic. The up against a little bit of selling pressure, but we see that it's that light pink. It's less than 0.5. and with the purchasing support below us, and the overarching theme that the purchasing support has rotated around, right? So now it kind of rotated completely around. It's completely under spot. So overall, pretty comfortable going long on the index. And of course, today, Friday the 27th, that paid off pretty handsomely with a 2.45% increase in spot, a 7% decrease in volatility. And the takeaway, or how that changed the hedging heat map, however, is that we now have a very linear gamma neutral zone, and it's located spot down, volatility up. So that means if spot goes down, volatility goes up. It's not really going to get any selling pressure, but it's also not going to get any purchasing support. In fact, we see that if we pick any spot, like say we pick like 400, as volatility increases, our purchasing support actually decreases, which is slightly concerning because again, we want that passive pressure, or we want that passive purchasing to be there when we need it the most. And when we need it the most is when liquidity is diminishing or volatility is increasing and the price is decreasing. But that's kind of the opposite of what we have. We also see that the purchasing support has regressed a little bit. It's kind of moving back to the leftward side. And the purchasing or the selling pressure is up here in the right-hand corner. So it seems for the next week that if spot goes up and volatility, even if volatility declines, if SPY moves up too much, it's going to start running into this purchasing support or the selling pressure. And what we've seen before in SPY, in particular in these kinds of situations, is that it will typically have a spot up, volatility down day, but the spot kind of moves more than the volatility. And this puts SPY then in the selling pressure. And so as the spot decreases, the volatility starts increasing. And that kind of like landlocks SPY inside of the selling pressure, which is definitely a risk that we need to keep an eye out for. However, for whatever reason, if spot drops and volatility also drops, which is a pretty uncommon situation, we will run into some nice purchasing support. So the take-home point of the hedging heat map is really just that it helps us understand the forces that are on a index or a stock that can directly influence the price. And this is one of many. And again, this can be pretty significant, especially when we consider that today, with the very large price movement and the very large movement in volatility, SPY generated an 83 million share hedging requirement, and that's negative. So that means that 83 million shares have to be sold. So although SPY is no longer in a gamma squeeze, it's going to start out the week with a pretty hefty bill that's over 100% of the current volume. And so that also still puts us at risk of this kind of subtle decline down the gamma, or down this gamma neutral zone, whereby if the hedging requirements kick in right at start, it's going to immediately drop the index. And without any purchasing support, really, especially if volatility increases, that can kind of snowball into a red week. So that's SPY, and I thought maybe it would be fun to look at something that wasn't an index, so I picked Apple, which is something that everyone enjoys. And so let's have a look at Apple. So just like we did with SPY, let's look at last Friday, May 20th, Apple hedging heat map, and then we'll put over top of it the progress of Apple for the week. And then we'll go through each individual day's hedging heat map, look at how the local environment was, and then see what the data currently says. So again, quick recap: blue is good, blue is purchasing support, red is selling pressure. However, Apple is it did start the week in a pretty precarious position, namely because the gamma neutrality zone extended spot down, volatility up. And again, I always want to know what's going to happen if something falls, especially in our current environment. And this tells me that if spot drops and volatility increases, you're not going to get any purchasing support. And in fact, if the spot drops too drastically, you're going to start running into that selling pressure, which can cause those runaway sell-offs, namely because Apple did start the week in a gamma squeeze. So again, this hedging heat map is reminiscent of how a gamma squeeze looks, because we have purchasing support above spot. So if the price rises, more purchasing has to occur. and selling pressure below spot. So if the price drops, selling has to occur. But thankfully, SPY, for various and sundry reasons, found itself in immediately on Monday inside of the purchasing support. And even after dropping almost to the edge on the 24th, it was quickly propelled up all the way till this Friday, very nicely inside the purchasing support. So let's look at the data and see what we see. So this is the 23rd, this is Monday, and right off the bat, so Monday, what did Monday do? Monday, we rose 4.01%, which is double what's the expected price range. So the expected price range was 1.94%. We also ended the day with a 6.3 million share purchasing support. This is for Monday. And we ended the day locally inside of purchasing support. So this is all pretty bullish. You already have, you have about 6 million shares of passive bid coming in. There's a little concern for mean reversion, given that we rose double the amount of what the quote unquote market was expecting. But at the same time, we ended the day very nicely inside of this purchasing support on Monday. So then Tuesday comes along. I imagine, did we drop what? About 2%. So we did mean revert. We also had a negative 6 million share requirement. So we're kind of neutral at this point with regards to that. But nonetheless, it's still pretty optimistic because we again ended the day on Tuesday with Apple being inside of the purchasing support. So although there's a negative 6 million share hedging requirement, that kind of offsets the positive 6 million share hedging requirement from the day before. The negative 1.9 some percent that the stock dropped is probably just mean reversion. You don't really move twice the amount that the market expects without a little bit of pullback. And if the crosshairs hadn't ended up hadn't ended up inside of the purchasing support, I would say this is pretty concerning. But we did, so that's pretty confidence provoking. And then on Wednesday, on the 25th, what did we do on Wednesday? We pretty flat, and then our liquidity dropped, and we ended up with a modest 800,000 share requirement to purchase. But we actually ended up in even, I think, with even a deeper blue, so it's a more strong purchasing support per the hedging heat map. So again, Apple on Monday and Tuesday, and then now on Wednesday, has progressed in such a way that for whatever reason, how the options were on Apple, it was constantly being surrounded by this very nice passive bid, even on this negative almost 2% day that preceded it, and now on this flattish day. Of note, though, we see that the gamma in this local environment, the gamma neutrality, the white space is pretty odd on Apple. So there is some concern that it may start to drop. But again, our purchasing support is actually getting deeper blue, so it's getting more strong. So this is a pretty confidence-provoking, especially if you're long. If you're short, it's definitely not confidence-provoking. So then on Thursday, how do we end up? So Apple is still, per Thursday's data print, in a gamma squeeze, but we see that the hedging heat map is actually starting to stabilize a little bit, where we have this nice purchasing support below. We do have some selling pressure above, but thankfully we see that the purchasing support at 2.6, the selling pressure maxes out at negative 1.6. So we do have, for what it's worth, a denser kind of like a nugget of purchasing support if spot goes down and volatility decreases. But even if spot goes down and volatility increases, we see that we do have some purchasing support here, as long as well, volatility would mostly have to be flat, right? So that would be pretty uncommon. So there is pretty confident that the stock Apple, if it did go down in price, volatility would probably rise, and it would start to collect some of that purchasing support. What did we do on this? Was after, so we went up another 2%. Volatility did drop 6.2%. And we did go up a little bit more than the market was expecting. Our upper limit for the day was 143.720. We ended up at 143.78. Not the worst. But we also see that nonetheless, we still got this nice 1 million share purchasing support. from this price action and volatility, and that's calculated from the hedging matrix below. But this is from, so for the hedging heat map, spot up, volatility down is within the gamma neutral zone. Spot down, volatility up is also inside of the neutral zone, but we see that the purchasing support is still, it's pretty healthy. It's there. So pretty confidence provoking, honestly. As long as spot goes, or as long as spot doesn't go up and also drive volatility up, we don't really run into too much or too significant of purchasing or selling pressure. And how cool, the next day on Friday, today, Apple's Gamma Squeeze ends. So we did get a nice little heads up. And also a quick caveat or a quick word. If you haven't, I would definitely recommend checking out the videos on Gamma Squeezes. They don't behave the way most people think that they do. For instance, the average stock in a Gamma Squeeze actually experiences quite a drastic decrease in price. And the hedging heat map gave us a nice heads up that the Gamma Squeeze was ending, which is always positive. The idea being that if stocks in a Gamma Squeeze drop, stocks not in a Gamma Squeeze might not drop. So we did end our Gamma Squeeze. We do have this nice steady purchasing support below it, or below spot now, regardless of what IV does. And we do have a pretty consistent selling pressure, but again, we would have to worry about that if we got to 160, which currently at 150, that would be healthy gains that could be had before that selling pressure really started to kick in, or healthy long gains, I should say. The only slight concern is that we are now pushed up against the slight selling pressure, and we really won't get any purchasing support until about 144, 145. So there is some concern that that spot may drop inside of this little vacuum zone or this gamma neutrality. Other than that, it's pretty good because we know that even if it does that, we can use this. If we say we bank on Apple dropping, then we can just wait for it to kind of floor out at 144 and then start going long because it'll probably bounce up. We actually have and which was probably with the 1.7 million share selling requirement starting out the week next week. That might be the nice subtle push Apple needs to kind of go down a little bit, especially with a 4.08% change in price, which is, again, about twice as much as what would be really, quote unquote, expected in the market. And so today had a lower bound to 141. So kind of rare occasion for me to do, but absolutely expect Apple to, it already has that immediate selling pressure from Delta, that negative almost 2 million shares. It's pushed up against the selling pressure from Gamma above, and it's at risk for mean reversion. So pretty likely that Apple will drop probably to the 144 range, which is near the mean reversion, or today's upper limit was. And then I would expect, as long as the data don't change too much, for Apple to kind of start moving back up because it has a nice stable hedging heat map. And so that is the hedging heat maps. I think they're super cool. I think they're very fun. They're dynamic. I like them because they don't include anything about the price action. They're not subjective. It's objective. It's math. It's based on things that must occur in the market, just because of the various ways that the market and all the institutions are interwoven. And it's actionable, right? It tells you where your risk is. It tells you where your profits are located. And I think they're pretty cool. So that's all I have for you guys. Thank you very much. If you guys are interested, head over to deepdivestocks.com. I have tons of literature on hedging, on Borex, on the reports. If you're interested in catching stocks that are in a Gamma Squeeze, I definitely recommend signing up for the Gamma Gainers newsletter. There's the free version, totally free. Every day you get half the list of the stocks that have started their Gamma Squeeze and a full list of stocks that have ended their Gamma Squeeze. Or if you want, you can go ahead and pay a little extra and get the full Gamma newsletter, and that gives you all the stocks plus a whole bunch of data, some more educational material. And then if you really want to take a deep dive and get these hedging heat maps all for your own, I'd obviously, because it's mine, recommend that you become a premium member. But again, I think it's cool. I think it's actionable. My members seem to like it. And so, yeah, thank you. If you guys like these types of videos, let me know. Like, comment, subscribe, and I'll see you guys next time. Bye.